guess we'll go ahead and start. One of the things that we all have to do July 1 is what we got to do about our retirement. And so I talked to myself. I had some questions, so I called Don Patrick, who's the gentleman standing in front of you, that you've all met. And Don is a OSU graduate. I know that much about him. He lived here in Oklahoma for a number of years. He's been in investments and so forth. He's been in California for about 10 years now. And he's not going to ask him if we could videotape it, and I knew he would agree to it because he's been on camera before. He's a movie star. And some of you may have seen him in a movie called Are You Lonesome Tonight? And this series, he really was in it. And I'll let him tell you a little more about it.
Wait, what kind of movie is this?
It was on television.
Oh.
It was a real movie.
TV on USA.
Not budget to pay for them themselves. That's all we want.
Depends on how lonesome you are.
So anyway, I'll let you give us some details.
Well, Harold, I appreciate the invitation, and I'm pleased to be able to visit with you about this. I'm not going to give you a sales pitch, because that's not what you came for. I'm going to try to give you an introduction to what 403 BTSAs are all about. In my opinion, most of the educators in the upper level, colleges in particular, are kept very ignorant about what's available out in the marketplace because they are enrolled, quote, into TIA, CREF, and you think there is no other choice, and you're just kind of stuck with it. And frankly, they're very limited in what they can do or will do for you. They're beginning to open up. This gentleman here was mentioned it a while ago. The TIA, CREF for years has been the fund for college level people, some high school level. We're developing and accumulating funds for your retirement to supplement Social Security or whatever else you might or might not have. And they would not let you have the options that are available during the investment period or at the point of retirement that all of the commercial funds are available and they'll let you have. They just wouldn't do it. Frankly, because they didn't want you to move it from them to somebody else. Now, competition, in my opinion, is what makes the world go round. I started in the business, and let me say this, my name is Don. You raise your hand anytime you want. You can call me Pat, DP, P, Mr. P, Coach P, or Dandy Don. Now, Harold's the one who stuck me with the Dandy Don. Just don't call me late for lunch unless you're going to take me down to Loualika. And down at Loualika, they got the greatest chicken fried steak in the world. I'm telling you, don't let anybody tell you any different. It's fabulous. God, it's fabulous. All right, now, but call me, just stop me anytime, because what we're here for is to learn. The title of what I'm going to visit with you about is called Control-Alt-Delete. Now, that's familiar terms with all of you, right? I don't care what field you're in. If you're using the machines I see here at your facility, Control-Alt-Delete means something. Basically, what's it mean? Start over. It's exactly right. That's exactly what it means, start over again. Let me tell you a little bit about my background, and I'm not going to give you my credentials, but when I started employment after graduating from college, I started coaching in Shidler, Oklahoma. Then I moved over to Ponca City for a year. After 2 years, I'm sitting in the boiler room where the coaches all got together to smoke, because back then you could not let the kids know you smoked. I didn't smoke, but to meet with my friends, I had to go down to the boiler room. One day I'm down there and another coach come in and he said, "Hey, today I bought a house." And I said, "Wait a minute. You're married, I'm single. You got a wife and 2 daughters, I got nobody. I can't afford to pay my mom and dad rent, let alone go out and buy a house. Now, you're lying to me. How did you do it?" He said, "It's real easy. I bought it with my annuity." I said, "Now I know you're a liar. Annuity, life insurance, you got to die to beat this stuff." No, he said, he explained, of course, that he took the cash out of his plan, borrowed it out of it, made the down payment on his house, and now his house payment was less than what his rent was. And I thought that was fabulous. A marvelous thing. I thought you had to die to beat stuff from insurance companies. Well, to make the long story really short, that's what got me into business. That spring, I took a look at several insurance companies because of that very interview that day with that man. And I moved into the business, and 32 years ago, I started visiting with people on the idea of how to accumulate money and the difference between spending money, saving money, and accumulating money. Now, I'm an orphan kid. I was born in, my mother left me on the doorstep of a little church in White Eagle, Oklahoma. And I can remember this day when I was 3 or 4 or 5, somewhere along in there, fighting for my breakfast with other kids. I was adopted by a good family, hard-working family. And I was the first kid in the family to graduate with a college degree. I worked through school, played baseball, and everything else, and so I know what a dollar's all about. And I know I don't have enough of it. I know that when I retire, at some point in the future, I probably still won't have enough of it. Because everything we do today costs more than it did yesterday. And that just tells me that everything we're going to do tomorrow is going to cost more than it is today. Now, you may not have enough if you accumulate a bunch of money between now and then, but whatever you accumulate is going to be a lot more than you're going to have if you don't do something about it now. Now, what's important to you is this, is that in 1968, the federal, or 63 to 68, along there, the federal government started enacting provisions that gave teachers, particularly, a special break on how to accumulate money and get a tax shelter for it. And why did they do that? There's a good reason for it, and most people are not aware of it. And I want to share this with you right now. In 1940, the Social Security Administration completed a survey on the savings habits of the people in the United States. And they found that out of 100 average people in the United States who started working, that most of them earned their first regular paycheck between 18 and 25 years of age. Now, is that when most of you went to work, somewhere between 18 and 25? Regular paycheck. Now, I know a lot of you may have had paper routes and other kind of jobs, worked on the farm and stuff part-time, but they found that the average person's income tends to do that. It goes up until they're about 50 or 55. And at that point, it levels off. Now, 50 to 55, after leveling off, at 65, now to 70, it stops. Between the first paycheck and the last paycheck that most of us draw, the survey tells us that the average person will earn somewhere in the neighborhood of $800,000. And that's really average. In fact, that's only $20,000 a year for 40 years. And every kid you got going through here will do a lot better than that, or you haven't done your job. Somebody with special skills, special training, like you've got, like I've got, and the people you're graduating will earn well over $1.6 million during this 40-year working period. But this isn't even the significant factor in the survey. This is interesting, but it didn't make any difference according to the Social Security study whether you were a doctor, a lawyer, a teacher, a ditch digger, a plumber, an Indian chief, or a baseball player. It didn't matter. Here's what was important. At age 65, only one of the original 100 is loaded. Now, I suspect luck has something to do with that. I mean, really loaded. The Kennedy, the Rockefeller type loaded. 4 of them have an income that won't quit. And it's substantial enough that they can continue living in the same style they were used to before retirement. And wouldn't that be a good feeling to know that the day you hang it up, that every month you can spend what's in your checking account, and the next month there'll be enough there to do everything you want to do? Sure it would. I mean, really, that'd be kind of nice. Unfortunately, 5 of them are still at work. Now, these 5 are lucky. Don't misunderstand me. They're very lucky. First of all, they're healthy enough they can go to work. And there are a lot of people that can't work because of their health. But these 5 are healthy enough. And they're also lucky that the boss, whoever they work for, hadn't given them a gold watch and said, out the door, cousin. So that's 5 lucky people. Now, you and I know people over 65, over 70, right here in this town, in Tulsa, Oklahoma City, anywhere, California, that are working. McDonald's is hiring a lot of old elderly people. Baskin-Robbins, Burger Chef, those people that need a security guard at night. There's all kinds of people working. Go talk to those people. American General Life Insurance Company hires them for switchboard operators and everything else. You call on the phone and you get a lady you know, she's 107 years old. I admire them for the fact that they're giving people like that jobs, and they hire like 4 of them for an 8-hour day, 2 hours a shot. That gives them a little income. Ask them why they're working. Are you working because you want to? Most of them are working because they have to, for a few extra bucks. They're not working for thousands of dollars. They're working for $200, $300, $400, $500 a month extra. These guys won't make it from here to here for one reason or another. But this will surprise you. Maybe it won't. I don't know. There's 67 people out of the original 100 in the richest country in the history of mankind. And these are documented figures. At age 65, have less than $100 in their bank account. They're dependent on 3 things: their own children, the church, or some form of charity welfare relief to make it on a day-to-day basis. That's why we've got ghettos in the cities. The ghettos aren't all black anymore. Now let me ask you, do you suppose that these 67 people, when they were right over here starting out at age 18 to 25, planned to work an entire lifetime, making this kind of money, and end up down here dependent on somebody else to help them through the day? I don't think they planned that. I don't think anybody plans it. Do you? Do you plan to do that? Well, I submit to you that most people spend more time planning a vacation than they do their retirement. And that's the business I've been in for 32 years, and the majority of my clients are teachers and educators. Originally in Oklahoma, I opened up 274 school districts and colleges for tax sheltered annuities. Back in those days, they had 1 slot on the machine for retirement funds. And you had to be the first one there, because if New York Life beats you, or American General beats you, or somebody else, then I didn't get a slot on the paycheck. In California, I currently service over 280 school districts in Southern California and 111 colleges and universities. I have 18,000 clients that I'm working with. Thank God for computers. But none of them plan to end up like this. But do you know why these guys ended up that way? They didn't plan to fail, but they failed to have a plan. It's that simple. That's a cliche, I know that. It sounds like a silly thing. But here's what they don't understand. The average person does not understand the difference between a put and take account and a put and keep account. This is called short term, and this is called long term. Bank accounts, credit unions, government bonds, savings and loan accounts. These are excellent ways to accumulate money, but most people do this with it. They put the money in today, and they take it out. They put it in and they take it out. They put it in and they take it out. They put it in and they take it out. And age 65 out here, the American Banking Association just published last week figures that says they have less people at 65 have $100 in their bank account than they did at 24. And I just drew you a picture of my bank account. You can grin if it looks a lot like yours, because that's mine. In 1960, I bought a red Chevrolet Impala. Neatest car on the road. I just graduated from college, had 6 months under me teaching, and I wanted that red Chevrolet so bad. Took all my savings. I got a stereo set. I got married.
It stayed down there.
It never looked back up.
25 years later, it went up a little bit. My kid said he's going to college. My daughter said she's going to college. You know, we get it all the time. What we really have here is not savings accounts. This is not accumulation of money. What this is, and I think you'll agree with me as you think about it, is delayed spending. Some of us are better at accumulating it over a long period of time in this form of savings than others, but most of us treat it just like that. Now, don't get me wrong. We all have to have emergency money, and we all have to have opportunity money. And that's what these accounts are all about, is emergencies and opportunities. Now, the other form of savings is called long-term savings or put peak. It's where you put a little bit of money in, and you leave it alone. And you put a little bit more with it, and a little more with it, and you keep leaving it alone. And the magic of compound interest causes it to continue to grow. And the longer it's there, the faster it accelerates, because instead of an addition factor, it becomes a multiplier. And only two things can happen to your money in a good account. And the government said when they first did this that you've got to be able to get it back at a time when you want it and need it the most, and you get it back with profit on it. That's out here at 65 or 70. Well, that's simple. We don't mind getting our money back. In 1933 or 34, Will Rogers made a comment. He said, "I'm not concerned about the return on my money. I'm just concerned about the return of my money." But nowadays, there's enough quality investments out there that we not only know we're going to get our money back, we can expect a pretty good return on it. The second thing that's going to happen is that if you are here to collect, you can name an heir or beneficiary or a family member, in other words, and they get it with a substantial gain on it. And you don't mind that, do you? If you can't have your own money, you can't be here to get it, you just assume let somebody have it that knows, you know, that you care about. Now, most of you I know believe in saving money. We all believe it. Out of every dollar in our budget that we could earmark to go into savings, wouldn't it make sense to put some of that money in bank accounts, savings accounts, and so on like that for emergencies and opportunities? Sure it would. But doesn't it also make sense that we take the money over here and leave it alone? You know why the law was passed? One thing that I think our legislators probably figured out better than anything else, they cannot afford to have the educators of this country retiring to the soup lines and drawing welfare handout money in front of the students and the sons and daughters of those students. They can't afford it. It would absolutely destroy the educational image and system that we have in this country, which has been why we progressed the way we have. And that was the catalyst behind the law for 403B TSAs. Now, you people are faced with a couple of decisions. You got money that's been put aside for you, or you've put aside some of your money with it, and you've put it into a fund called TIACRF. And that's certainly got a highly recognized backing. They're strong. They've certainly done a good job with your money. I submit to you that there's some alternatives that are worth considering. Any questions about this right now? I thought I'd throw that out because that's the catalyst behind this whole thing. There's some general uses of money that you're not even aware of. I'm shocked to find that educators do not know in Oklahoma particularly. And I don't know why it should be any different here. In California, the price of real estate is so astronomical that teachers out there, educators out there, use their TSAs to buy their first home, and in many cases their last home. And in some cases, they're only. Now, Harold, I've been spending the night with Harold last night, and he's got a beautiful, wonderful home. Harold would give everything he's got to get that home to where I live from the island of Coronado in California. Guaranteeing you, without any hesitation, I can get $1.5 million or better out of that house. And no yard with it. No lease yard. The price of homes is really astronomical. The law says, the TSA law, 403B provision of the tax law says, you may deposit money from your paycheck or match it with funds that are put in there for you by your educational employer. You may pull that money out at any time you choose to use for the payment of a home, the down payment of a home, the refurbishment of a home, the improvement of a home, the refinancing of a home, if you want to. You don't have to ask permission to do it. How many knew that? That's just one thing you can do. Now, a young couple, I see a couple of young gals here, a couple of young guys back there. Think of, you start off in life, some of us really struggled to go through college, had no money coming out. The thought of being able to buy a home was one of the things we loved to do, but it was down the road a ways. And even then, you got to what? You got to have some money to make the down payment. Back to where I got into business. This is marvelous. There are other things. You've seen in the last 2 years in California, you've seen horrendous fires. Burned open. 7,000 homes went just like that. You've seen mudslides where a house went. I had 2 teachers last month that their house went. Slid right off into the ocean. Here's a guy with beachfront property. The view alone's worth $1 million, really. Sitting on the beach. And the next day, his house has slid into the ocean, and he's no longer got that property because you cannot rebuild it or put it back up after. The coastline is not reusable once it's been forced away. So emergencies do occur. I think I got it spelled right. If not, emergencies. Anyhow, you know what I meant. It's too close to the board, so I can't sleep. In fact, the law says you may borrow the money. You don't have to give them a reason unless you want to get the home. You give them this reason because of the length of the repay. There's a repay. If it's a loan, it's got a repay, doesn't it? We'll talk about that in a minute. But here you can get a 5-year loan for no reason at all. For emergencies, you can get 15, and for a home, you can go clear to a 30-year mortgage loan repayment. And you say, but, how much? Now, who are you going to repay? KIACRF? New York Life? Transamerica? Prudential? That may be who you have it with. But the law says that you may borrow your own money out of your TSA to do these things. And the law says you pay yourself back plus 2% interest. Why not be your own banker and your own bookkeeper, Harold? I mean, if you're going to let somebody do it, why not you? They've even improved the products. Now, let's talk about products for a second. I hit you with this right quick because I want your attention, but it's the truth. I don't know how many hundred teachers I've had pull money out, started out with $100 a month or less. In a few years, it's built up to where they've got enough money to buy that house. It's a thrill of a lifetime. And I get invited every time because they think I had something to do with it. It's really a thrill. The products have improved so much that originally these loans were like, let's say, 7%. And the competition got with it. And it went to even 2% loan. And now they have zero basis loans. Some products.
How do we get 0 basis?
Doesn't cost you anything.
Well,
They pay you 4.5, you pay 4.5, that's a zero base loan. They're not in the business to make money on your money. You see, the truth of it is, the money in a tax shelter annuity is your money, not theirs. So why should they make money off your money? Makes sense, doesn't it? I'm sorry?
It's their business to make money. I mean,
But they're not
you're
in-
giving them the pleasure of having your money.
Well, let's think about it a little bit. You got money in a bank account. It's called a savings account. And they're paying, I don't care what the interest rate is, anywhere from 2 to 20%. And if you went in and pulled money out of that account with the intention of paying it back and you signed an agreement with yourself, do they have a right to charge you for that money? Same thing. Same thing. This is nothing more than a very high profile savings account for a special group of people, the educators. Now, they even have now where you pay the interest rate, let's say, is they charge you 4, and you repay it at 6, but that means there's a 2% difference there. But that 2% goes back in your account along with your principal payment.
So you're paying the 2% to yourself?
Literally to yourself.
But you're also losing what they would have paid you had it been in there. That's costing you that much.
Well, you can't have, now, that's true, you can't have something for nothing. For example, if the money was in there and it was earning, 7, 8, 10, 12%.
Let's say it's 10% that it's
Okay.
earning. You borrow it
You had
out.
$100,000 in there and it was earning 10%, then you got a $10,000 earning at the end of the year. But if you took 50 of that out, you're not going to get 10% interest on the 50 that's gone
You've lost 5,000.
For the period
It
of
cost you
time.
5,000 to use that.
for the period of time
Right.
that you've got it. Right. Again, go back to your bank account. If you had a bank account with 100,000 in it, you took 50 out, you're not going to get interest on the money you took out.
So it cost you that much to use it.
The use of your money,
But you don't have to pay taxes.
At a 0%.
But you don't have to pay taxes on
You're
it.
actually taking out less than 5%.
That's where you make your
Because
money.
you take out
Not
50%.
necessarily.
So you don't have to pay the penalty or taxes.
You may have
$1,000,
already
you're
paid
paying
taxes on it, depending on what it was.
5% of it back, and you get 2% of that back, you're really only getting 30.
well,
Or really having to pay for it.
no. The point is very simple. If you had, you could just run parallel with a bank account. Just run it parallel with a bank account. You got a bank, and you got a TSA. What difference matter whether you call it an ESL, a Chevrolet, a TSA, or a bank account? Who cares what you call it? If you've got $100,000 in this, or I don't care what it is, say $40,000 in here. You had 40 in the TSA, and this one's earning 10, and this one's earning 10, you're going to get a $4,000 interest on the account at the end of the year, aren't you? This one is taxable. You pay tax on it, whether you spend that $4,000 or not. This is not taxable, so the accumulation is much better. It's tax-free or tax deferred. Now we come in here, we got $44,000 in both accounts. And on this one, you take out $20,000. You're going to have $24,000 left over. What's the interest rate? It's still 10, so you get 10 on that. Over here, you got $44,000. You're going to take the $20,000 out. Okay? There's no tax for taking the money out. You still have $24,000. The interest rate's 10% on the 24. Now, the only difference we got is, are you going to pay 2% for the money? And does the 2 go to yours, or does it go to the insurance company? Either way, the traditional method is the interest rate that you pay goes to the insurance company for handling all this stuff. But in the last 2-3 years, the products are not getting so good, and the consumers are have enough leverage, so to speak, in dealing with them that they say, wait a minute, you're charging us for our money and for the use of my own money. I should be paying me, not you. Oh, you should maybe have a little fee that you can charge, but not the full interest rate. So they've either got 0 basis loans, or the actual 2% goes into your account along with the repayment of the money you borrowed. So if you pay 2% on this loan, and it went into your account, even without a principal payment, 2% of the $20,000 you borrowed is what, Harold? $400. And so that $400 would be credited back to your account as earned on your money. Your point's well taken with the 20 gone, but you spent it. Sure, you're not going to get big interest on it. You're not going to get the main investment. But the minute you put it back, you will. Because the minute any portion of it goes back in, you now begin earning your big interest. Okay? Question?
Well, any payments you make on that 20,002 will go back into your account.
That's what I'm saying. Any portion of the principal of the loan repaid.
On the TSA, you
Yes.
said that was interest-free.
No, I said it was tax-free.
I'm sorry, tax-free. When you pull that out.
Right.
That is a
It's
tax.
a non-reportable event. It is a non-reportable event. You don't even have to tell them about it.
If it's taken out for what purpose?
Any purpose?
Home,
Home,
emergencies?
emergencies?
Just to borrow?
Yes. The length of repay is the purpose dictates the length of repay. But the purpose does not dictate the use of it. All you got to do is call me on the phone and say, Don, this is Harold. I need $10,000. How fast can I get it? And I said, Harold, I'll mail you the forms tonight. Sign them and mail them direct to the company. You'll have it within a couple of weeks. Is it an emergency? And Harold says, no. Then I said, it'll be a couple of weeks. If it's an emergency, I said, Harold, I'll call tomorrow morning. I will notify them. They'll cut the check and be waiting on the form that you're sending in. And they'll have it to you within 5 days. That's it. They don't ask why. It's none of their business why. Unless you want a 30-year repay. I mean, it's dynamic. This is a wonderful thing. You have what's important about it is that you have not had this option with TIAC or F. They won't let you take the money out. And that's wrong. Because the law says you can. Now, they're not the only one. So I'm not going to pick on them. American General is a fine company, a big, giant company, home based in Houston, used to be in Oklahoma City. They have no loan provisions in their TSA accounts. As a result, I don't sell their TSA accounts. You know, if the law says you can do it, why take that option away from my client? Okay? Now, vehicles, that's the type of annuity or type of plan that's available. Vehicles have changed. The first car I ever drove was, I think, a Chevrolet 1932 or somewhere along in there with a rumble seat in the back. Little sparker thing there, we'd get out and we'd grind on the front end of that thing. Half the kids that we run around with broke their arm with that thing. The second car I drove was a World War II Jeep that one of the kids' dads bought after the service and brought it home in 1946 or 47, somewhere along in there. And then I went to a 49 Ford, and then a 55 Ford, and to a 61 Impala, or 60 Impala that I told you about before. The new Mustangs came out, and today I'm driving a newer car, you know. The vehicle's getting better. It can do a lot more things. They're air conditioned now where they weren't. I mean, there's all kinds of things. The product line that's available has continuously improved. I don't know how much more it can improve from where it's at now, because I've been to Bendis 32 years, and I can't think of a lot of things they need to do to it to make it better, but I'm sure something will come along. Most companies, when that happens, will automatically make a part of the provision of the old contract what the new contracts will do. That's not totally true, but most companies will today. Your better companies do. So if there's a new innovation or improvement, they'll make it a part of the old contracts, even if they're in existence for several years. Now, what's that important? When I first started in the business, I went to work for one company. That's kind of the way you did it. You either had credentials stamped on all four cheeks, or whatever company you went to work for, and that was it. You sold what they had, or you enrolled people in what they had, and if they didn't have it, you didn't sell it. It's as simple as that. In fact, when Harold and I first met and started working with kids in baseball program, I was with Franklin at the time. Very fine old company, had a lot of good products, not the best of everything, but I was stuck with whatever they had. That's what I had to peddle. And that's who I started opening school districts up with. They had a great TSA program. Today, I formed my own company in California when I moved out there 10 years ago. We call ourselves Sun Country Financial and Insurance Services. We're contracted with 60 life insurance companies and over 900 mutual fund companies. So that's not everybody, but it's a cross-section of a lot of quality companies. Why? Because no one company has the best product for everybody at all times. And I don't care whether your dollars go to Prudential, New York Life, John Hancock, Franklin, Prudential, Chubb, or whoever, as long as I'm your agent and you've got the best that I can get you. I don't have to apologize or alibi for anything you got or that you get from me, because I've done a lot of work to make sure I've got products on the cutting edge. It's really warm in here, Harold. Is there a way to cool this place off? Because I feel heat coming. You?
It's cool for this building.
Is it? Okay, well.
Those energy techniques.
Okay.
You're up jumping around.
Yeah, getting excited here. Flexibility is a very important key. And there is a difference in flexibility. For example, some products, when you start into them, you can't change the premium deposit. Other products, like we've already talked about, won't let you take the money out in the form of a loan. Those are points of flexibility. And in dealing with my customers, I feel like it's important that you have all the options that we can get you. I feel like we ought to have all the options we can get you without having to cost you anything. Or at least keep the cost, if there is a cost, at a minimum. And I feel like that you ought to have investment options, as many as possible. There are three basic kinds of funds that you can start, or accounts, you might say, that you can start in a TSA. One is called a fixed account. Number two is called a mutual fund. Number three is a variable account, variable. When they first started, they also had a product called life insurance. And you could get a TSA life insurance policy. Can't do it anymore. There are a couple of companies that have kind of an off-breed version, but it's not attractive. Now you have fixed annuities. A fixed account or fixed annuity product is simply something where the board of directors of the company votes on how much interest they're going to pay you on the money you got in the account. And they fix it for a period of time. Fixed annuity, fixed period of time, fixed interest rate. It's that simple. A mutual fund, a lot of time, yes ma'am?
Is there a bottom on that, a bottom limit or anything?
How much you can put in?
The way how much the board of directors can decide?
What is that usually?
Good question. There is a floor. It's an excellent question. There's a floor of usually 4%.
Okay.
Usually, okay? I mean, each company has some companies have some variation, but basically 4%. Now that used to be kind of it caused a little giggle in the class, 4%. The bank rates today are 2.78, CD rates are 2.75. That's not so funny anymore. 4% guaranteed forever. They will guarantee that no matter how bad the world gets, as long as they're in existence and you're in existence, they'll pay you 4%. Either that or learn to speak Russian, one of the two. So it's not such a bad floor guarantee. While we're on floor guarantees, how much is the floor guarantee of the mutual fund? You got it, Harold. That's how much. There is no guarantee. And on a variable account, both. You have a minimum floor of 4 or 0 depending on the type of investment within the contract. I'll explain that later. Principal guarantee. By the way, while we're at it, how much does a CD guarantee forever? Certificate of deposit. Name the bank, I don't care. We represent, by the way, 843 banks. You can call me and you can say, Don, I want to give you $10,000. I want to buy a CD. I want the best CD you can get me for a 6-month period or a 1-year period or a 5-year period or a 10 or a 20 or a 30-year period. And I've got instantaneously, I can pull up the best buy available on a certificate of deposit from a bank modified in the United States or anywhere else for the length of terms that you want. And it won't be the one down the street that you're passing every day you go on to school. Probably. But it could be. We have 843 banks. What's the guarantee, Harold? Anybody?
Zero.
For the period of time that you bought it, there's a guarantee. Beyond that period of time, you have no guarantees. I want you to understand that with CDs.
Yeah, when you go from 8% down to 4.
Well, how about from 6 to 3 or 2? You know, yeah, we have a lot of people. I'll tell you a real interesting story that, real quickly. My offices are above a bank. It's a 2-story building, and I have the 2nd floor above the bank below me. And one day, we had 7 people come upstairs with their IRA funds. Ranged all the way from $30,000 to about $160,000 for a husband and wife. And the 8th person that come up the stairway was president of the bank. And she said, and I quote, "Don, I'd like to visit with you. I'm not mad, but I want to know why everybody downstairs is bringing their money up here to you. Would you take time to explain to me?" I said, "Well, certainly." So she sat down and I went through the whole thing with her. It took about an hour and a half with her. She said, "I thank you. I'm not mad. I really understand now." She got up and left, and I thought that was the end of it. Less than 20 minutes later, she came back with a cashier's check of her own and said, "Here's $52,000. Would you please roll this into your IRA program?" She had her money at 2.78%. She said, "I don't want that money anymore. I don't owe them that allegiance." Now, principal guarantee. In a fixed account, principal, that's your deposit, is always guaranteed to be there. 100% principal guarantee. The mutual fund, the principal is not guaranteed. It can go up and down. Here's a picture of it. That's the truth of it. It can go up and down. And a variable account goes up and down, but with a guaranteed floor of 4% earnings on it in the fixed portion. So it's a half-breed. This is kind of a cross between this and this, and there's some other features as to why it's an attractive idea. Questions? Okay. Remember, all of these have these provisions. Loans, homes, etc., emergencies. They have withdrawal privileges. You don't even have withdrawal privileges with TIA-CRF. They all have those privileges. Now, with loans, you have the right to pay it back. With withdrawals, you can't pay it back. You withdraw it. That's nice. There's a 30-year capability, 15-year capability, 5-year capability. All right, now, deposits. 2 kinds of deposits. There's a monthly deposit, and there's called a rollover deposit. The law says that if you have money in account number A with whoever, you may roll it over into account number B anytime you want. It's your money. TIA-CRF has been bucking the law for years and years and years that would let you do that. And yet they were accepting rollovers from other companies. That's how they cut their own throat. They've been ordered now to comply with the law like everybody else. They're feeding the law to you kind of slow. You've had a couple of bulletins and they kind of imply certain things, but not all the things. And that's part of what's behind it. I'm not saying they haven't done a good job. I'm not saying that they might not even be super competitive. They're competitive. What I am saying is that at times they have not been, I think, as beneficial to the client as they could be because of the way the law's already providing you with different options of opportunity.
Question, though.
Yeah.
Does the rollover have to be complete, or
No.
can it be like a half?
Excellent question. The rollover can be partial, and there's no law says there's no differentiation. You can make it any partial amount you want, or it can be total. I'm a big believer in diversification of assets.
Is it a one-time thing?
No. No, you roll it today, and next year you say, hey, I want to roll it over to C. Next year you say, I think I'll roll it back over to A.
Has to be a year.
No, me next week.
Could be done monthly.
There are sometimes it's not an attractive idea. Let me say this, because there are things called surrender charges in some accounts. Now again, let's take a CD. If you have a CD for a 6-month period and you bust it early, what happens? Have a little penalty. Some of the accounts, some companies and some accounts, and they're all different, have a little surrender charge if you bust it early. Some of them have horrendous surrender charges. We don't sell them yet. I wouldn't even show them anybody. 30 years surrender charge for 30 years? Come on, you know. You're going to leave your money there a while, that's for sure, but that's not attractive. Not when there's products out there that are 5 years or less, 7 years or less, and they decline.
You may outlive your beneficiary.
Yeah. Okay. So you can roll partial, roll totals. And I encourage my clientele to, even if they have all of their accounts with me, I encourage them at certain point levels to start a second fund or to roll into and to diversify your, even if it's doing well, to diversify the management of the money you got as well as the investment type that you got it in. It just makes sense to me. I guess maybe my granddad said, don't put all your eggs in one nest. I guess that's where I'm coming from. Most products out there are very user-friendly. Oh, I should say the monthly deposit amount, $25 a month is the minimum. I mean, you can get started for almost nothing. And I submit to you, I don't care if the school is putting in a chunk of dough for you every month. If you don't put a little bit of your own money in there with it, you're just making a big mistake. You know why? This is with the tax shelter. This is without. For you to go down to your bank after you've drawn your check and put $100 in the bank, you know how much it's cost you? You're not saving $100. You've paid income tax on whatever you had to earn to get that. If you're in a 25% tax bracket, you have to earn another $25. That's $125, have them pay the taxes out of it to be able to save the $100 at the bank. It's as simple as that. You understand that? Now, if you save $100 before taxes, how much does it cost you? To make it real simple, it's only cost you $75 because you've avoided the tax. You were paying this tax anyhow to the government. The true cost of that's only $75. Now, it's a little off, obviously, because, okay, it's just a hair off, but the concept you understand. The difference between saving $100 in the bank, now which would you rather have? That's a 50% almost difference between putting money in the bank after taxes and putting it in there before. That's up front. We're not talking about interest on your money yet. Why, in God's name, would you give, or anybody else's name, would you give the government $25 you don't need to give them and go down to the bank and put it in the bank when you could put it into a TSA? Yes, sir?
But this is not tax-free.
Didn't say it was.
No, we're going to have to pay tax on it eventually.
Maybe.
And the interest
No.
eventually.
No, let's don't put it that way. I really want to
Unless
change
you
your
die
thinking.
first.
No, no. Well, the truth of it is, here's what it is. It's deferred. Okay? Deferred tax plan, okay?
That's right.
But for you to say you're going to pay tax on it is very wrong. What it means is that at some point when you start spending that money, you must do what? Not pay the tax. You must report that as income. And I submit to you that at age 65, you have double exemptions. At age 70, you have even more. You have other exemptions, deductions, etc. You may or may not pay the tax. You must report it. You may or may not have to pay. I can't predict what the tax law is going to do to us in the next 20 years, but I guarantee you what. I didn't vote for Bill Clinton. I don't know what you voted for. I don't want to get into politics here, but he's the greatest thing that ever happened in my business. Because every one of these stupid tax things he's fixing to whip on us makes tax shelters like this far more important as far as accumulating money. Now, product-wise, there's another reason why the reporting is not important. Only about 70% of the money accumulated through an annuity at the point of retirement is a taxable event. There's actually another break on the tail end. So you avoid tax when you put it in. That means that it's not taxable deposit. No tax on the deposit. You avoid that tax you were paying. It's tax-free accumulation. And upon reportable, it's only partially a taxable event, about 70% of your accumulations. There are breaks on all three areas.
Now, 70% of your accumulation, you're talking about the interest,
Both.
or the total
Remember,
accumulation?
Sure, because your deposit was deductible, remember, so you never had to pay the tax on that money.
Well, let's go back to a 25% tax base,
Okay?
which...
You put $100 in, but you avoided a $25 tax.
That's right. Immediately, you save
realized your
25% of it.
That's right, that's up front.
Then you're going to draw interest on that additional 25%.
At whatever rate.
For the number of years that it's left in there.
That's right, and that's not reportable while it's going on,
Until it's withdrawn.
until you start withdrawing.
But, of course, when you withdraw it, we don't know what the tax structure is going to be.
No, assuming
But now,
it's the
you're
same.
saying that the reportable portion now down here, when you do draw it out, where's the 70% coming?
That's roughly, whatever you draw out at that point, only about 70% of it is a taxable event. There's portions of it not taxable, even then. Because of the annuity payout and the way the annuities pay out and so on. It's not all a reportable event. There are tax breaks, 3 tax breaks. Going in, during accumulation, at the end coming out. Unless you take it all in one lump sum. I mean, you're right about that. Don't take it all out in a chunk, because you're going to pay a bunch in a chunk. It'll throw you into higher tax brackets. It'll do all kinds of crazy things.
So what if we do take it out in one chunk, and then is there any investment that can be used without reporting tax on it?
Yes,
Being,
tax-free bonds. California tax-free bonds today are yielding 9.72%. U.S. federal tax-free bonds are yielding about 7.3%. Yeah, there's accounts out there. Okay? Anything else? I just want you to understand that when you save $100 before taxes, that's 25%, 18%, 33%, whatever tax bracket you're currently in, up front before we ever talk about an investment return. And I submit to you, you name me one place you can go today, bank, savings, loan, wherever else, that you can get a 25% up front, day one, on anything. It just isn't going to happen. But a tax savings of $25 per 100 is day one. It's a dynamic law. You guys have the best tax shelter in the continental United States today. All other forms of tax shelters have been messed with and whittled with and chopped at and all kinds of stuff. You guys got the tricks. Okay. Now where am I at? Again, don't forget, there's 3 ways of taking money out of the account: withdrawals, loans, and then there's the disbursement options. You can take disbursement options, and that's what most people think of when they think of an annuity. That's when you start taking money out of it. I'm retiring now or something, I won't start taking money out of it. Those are disbursements. If it occurs before 59 and a half, and you can do it before 59 and a half, most of the time there are penalties. The penalty is significant. 20% plus the tax. I mean, that's a waste of money.
Is that TICREF also?
Everybody. If you could get it out of TIACRF, well, no, wait a minute. We're talking about taking it out, putting it in your bank account, or going somewhere with it.
Drawing out the whole amount.
We're not talking about rollovers. Rollover, I said what? You have the right to roll it without a tax consequence to another investment. Here, we're not talking about that. We're talking about taking it out and spending that booger. I guess I'm pretty good. I'm about to lose everybody here. We're down to 5.
Going on 7.
One more than 5, that's going to be more than 65.
We got a 20% penalty plus tax. But that's not on that's not on annuities, that's just on straight withdrawal.
That's on straight withdrawal. If you take it out and you put it into anything other than a 403B approved product account, you have a 20% penalty and a tax. It's a waste of money. I submit there are ways to get the money out, but you don't incur this penalty. Let's take the loan, for example. Everybody hates the word loan. Well, I understand. That's typical. You go down and borrow money from the bank owns you. We're not talking about that. We're talking about borrowing it from who?
Yourself.
Yourself. Now, if you can't get good terms with yourself, sure, there are some federal requirements, but the terms are great. Don't let that loan word hang up on you. You can borrow early, and you can borrow it in monthly chunks. You can borrow it in every 6 months. You can borrow it once a year for what you need for a year. Now, it's true, there's a repayment schedule, right? Unless it's a zero-based loan. What's wrong with that? And the repay schedule might be so insignificant that you don't mind making that little repay schedule to keep it legal. I wouldn't. Who are you paying it back to?
Save 20% up front.
And who are you paying it back to? You're paying it back to yourself, aren't you? Then what can you do? You can borrow it out again or withdraw it. I mean, you know, you're becoming now your own banker and your own bookkeeper, and the law gives you the right to do this. You don't have to withdraw. You don't have to take it out. You can roll it over into some excellent accounts. I gave Harold, or had some sent to him, that's an option that I particularly like, and a lot of people in California really have liked it. And I'm assuming that people in Oklahoma would too. It's called the variable annuity. And it's called the Best of America 4. And what I like about it is the fact that it's flexible, it has options, and it has a diversification of the investment that's just incredible. Taking money out at retirement time has to occur no earlier than 59 and a half, but no later than 70 and a half. The law says that at 70 and a half, you've got to start taking a disbursement out of the account whether you want to or not. And a majority of my teachers that are graduating or retiring in California do not want anything. They want to let it ride. In fact, at 70, they still aren't taking money. By the time they reach from about 65 down, they have learned to live on less money, and they really don't want to draw the money off of it. They want to keep that as their nest egg, but the law says you ain't got no choice. So the insurance companies have become pretty creative, and there are several options that are available. The original option, which is why most people don't like the word annuities, is one that nobody ever takes anymore. It's called the lifetime option. At any age, you can elect to take the money on a lifetime basis, and they can calculate this, merging the principal, the interest earnings, and your lifespan, mortality tables. But what is no good about this is, once you elect the lifetime option, you're locked into it. Can't change it. Plus, if you die next week, you forfeit everything. Now, what makes that a good deal? That's a lousy deal. But most people think, when you mention the word annuity, that that's what you're talking about. And it just isn't anymore. Sure, the option's there, but who's going to take it? In 32 years, I've had one person take it. And I did everything I could to talk them out of it. Other options are 10 years certain, 20 years certain, 30 years certain. There's other certains. What's this mean? This means you start taking an income out of it. It's guaranteed for life, but no less than 10 years of it. So if you if you had 100,000 there, for example, you could draw, say, $8 1,000 a month. So that's $800 a month. On a 10-year certain in life, that would mean that if you drew the first check and died, somebody else will get the balance of 10 years paid to them. Or they can take a lump sum distribution. Or if it's 20 years, they drew your first check. Usually that means this one would be, say, $750, and then 30 years might only be, say, $700. So the longer the guarantee, it's a little less. But obviously, if you die before the guarantee period's up, somebody's going to still get money. And this will pay a larger sum of money than this one. These aren't even the options that most people take anymore. Nothing wrong with it. But most people don't take those. Most of my clients are electing one of three. They're called. One's called a split dollar option. Another one is called minimum distribution. And the other one's called systematic withdrawal. I lost the word. Systematic withdrawal. Now, what those simply mean are this. The split dollar option, if you had 100,000, you split that into 66,000 and 33,000. You take the 33,000 on a 5-year guarantee. And that's going to pay you about the same as I was giving you before, about $800 a month for 5 years. But at the end of 5 years, it's gone. You've wiped it out. It's zero. But during that period of time, this has continued to accumulate. And let's just say whatever rate, say 7% or 8% or 9%. So what happens? At the end of the 5-year period, when this one now hits zero, your 100,000 has been restored. And you make the decision again.
Who gets the other 1,000?
Where?
100,000. We started off with 100,000.
Right.
Here's your
And we went to 66 and
Yeah, that
33.
comes to 99, 66, and 33.
Oh.
That's his profit.
Which is at 66.
He told you I graduated on his shoe.
Thank you, Tony.
I mean, I've been to Houston with a load of hay and come back, and it cost me $1.50 a bale. And on volume, I got $1.44 bail out of them,
What'd you say for the 66,000 this week?
Just leave it.
It stays in an accumulation annuity. In other words, you don't mess with it.
At 7%,
Well,
8%, whatever.
whatever the interest rate is, don't hold it. The interest rate here I'm giving you is not the magic thing. I'm dealing in concepts.
Exactly right, yeah, this one.
The point is that at the end of the 5 years, you've had the steady income that was equal to that 10-year certain. But you have an option now to change again in 5 years, and maybe you need more, maybe you need less, whatever. But you have that option. And this meets the federal requirements on distribution regulations.
Is there any limit on percentage distribution of that, what you've explained there?
Well, the limit is just the mathematics of it. In order to guarantee a 5-year and then restore it in 5, this interest rates have a bearing on it, but
Yes.
but it's
I mean, you could
60.
go 50-50, you go
Yeah.
70-30.
Oh, yeah.
That's an individual
Well, to
decision.
meet the federal regulation, though, it's a 33-66 split. 1/3
Percentage.
of the original account. That's split dollar concept. The thing that's nice about it is you have lots of opportunities to make an option, and truthfully, this option can go on for infinity.
We live forever on the same amount of money.
Well, but even when you die, the balance of this is paid to whoever your heirs are. It finishes the 5-year period.
And you still got that.
And they have the decision now to do what you did. And it literally goes on for generations. It will never stop. That's one of the exciting things about this option here. It's great.
Your beneficiary then can name another.
Everybody has the same decision every 5 years.
No. You've got that money working for you all the while.
Let me point out this.
The interest rate doesn't.
This money's always yours. There's no control about somebody else. This is your money. Absolutely no restrictions on it.
But if you take,
Let's say you elect this one.
our people around here, they go in, like I say, they take a life pay or a 10-year or 20-year pay,
Bad decision.
then that money on life pay belongs to TIA credit
Right.
when you die.
That's right.
And on a 10-year or 20-year pay, you get what they owe you up to that 10 years or 20 years.
You can still be kissing off some money. And in this case, let's say you took this option here and in 3 years died. 2 more years are still to go at the same rate of income, payable to whoever you name as an heir. If it's your wife, she gets the whole thing. She gets the same amount of money. Or if it's your husband, he gets the same amount of money. If it's your kids, they get the same amount of money. At the end of 5 years, you've been gone too. Mama's been sending them a check with love. And I have people's checks go to their heirs and say, with love, Mom, or Dad, or whatever. It's neat. They don't ever forget this. I know I'm playing a little emotions in this, but there's emotion in this anyhow. So we're talking about your hard-earned money. I get very emotional about
You got
it.
$100,000 in the
You got it all over again. So Harold's gone, Les and the kids make this decision again. They said, well, we'll take the same option. So bing, 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 here it goes. 5 years later, they got to do it again. You know, here's that 100,000 back again. They split that booger. I mean, there is no end to it. That's a neat option. It's only one option. You don't have to take it. You don't even have to repeat it. Okay, another option, minimum distribution. There's a federal calculation. I'm not going to go into it now. But the minimum distribution, there's a minimum amount that out of every 100,000 you've got to start drawing, and it's roughly 7%. So that means that if you had 100,000 there, you have got to start drawing $7,000 a year, no later than age 70 and a half.
Ain't gonna last that long.
Now, in doing that, your 100 will continue to grow, by the way. The 7 comes off, but if interest rates are at 10, anything over 7,
You're still getting
then your
that.
principal here is going to continue to grow on down here. So that's not a bad option, particularly in the dates and during the period of time now that we have some good interest rates in the annuities or mutual funds, like that. And keep in mind, you or whoever in your family always has the right to switch this, because this is a distribution option, not an annuity option. And that distribution option can be changed at any time to the split dollar option or whatever you want to do. And then you can switch back if you want to. It's a dynamic way to use money anymore. These options weren't available up until the last 3 years. Systematic withdrawal. Well, withdrawal is different. See, withdrawal is where you're taking the money out. And a systematic withdrawal is just, here you've got 100,000. Man, Ralph wants to go buy a chicken ranch, so he slices out 40,000. Or he says the ranch is going to cost me, and this would be a better way to do it, the ranch is going to cost me $1,000 a month, so he just starts taking $1,000 a month, whatever it is, and it lasts as long as it lasts. But it's a withdrawal provision, so he can change anytime he wants. The thing I don't like about the traditional distribution options of an annuity is that once you elect them, you can't change them. But with these three, they're changeable at any time by anybody, whoever owns the account at that time. And I like flexibility. I like being able to make my decisions because I don't know what I'm going to need to do 5 years from now. You may have everything set up so beautiful you think you got it nailed.
That's the
And something will come out of left field.
That's the time you want to be aware.
Something will come out of left field and surprise you. Okay, I told you that I was going to share with you ideas called Control, Alt, Delete. That means start over. Here's what I'm trying to share with you is this. It's time in your life, in your working career, the best time to do it's right now. Not because it's 1993, because now is the best time to do it. Take control of your investment dollars. I submit to you that you make a big mistake if you leave it under the leadership of the CREF concept or TIA concept. If you can get some of it out, get it into another fund and keep it tax sheltered without an expense of doing so, you ought to do it. Because it gives you a distribution of your investments It's a safety factor. The second thing is you alter the method of investment option with safety and yet growth. And the third thing is you delete the expenses of the waste of income and the waste of tax dollars. You capture them yourself and you put them to use for a good profit. Control, take control, alter the way you've been doing it, and delete expenses. I'll be glad to come back next month or so. I can't come every week. I would come on a regular basis if enough of you became clients of mine. I've got to make a living and I've got to meet my expenses too, but this is my home. If anybody, I won't get personal today in this meeting. I have no intention of doing it. I have materials available, and I will come back for private conferences for anybody who wants to. I can schedule to come back about a month from now or so. I'll come to your homes, make a committee, or I'll meet you here at the school. I will not use any high-pressure tactics. I won't use them because we're not in that business. It's your money. I submit to you that a lot of people think you have to have a lot of money to do something, and you don't. A $100 deposit on a tax-sheltered basis is only costing you $75. I can pick up pop bottles, aluminum cans, and plastic bottles between here and Safeway, or whatever the name of your supermarket is, on a daily basis, and I can save $75 a month. I'll bet you. And if you're not submitting, I submit to you, if you're not saving that kind of money in addition to whatever the school will do for you, it's a serious mistake. In 10 years' time, the accumulation of $100 a month deposit, I'm sorry, in 7 years' time, $100 a month deposit is worth $14,700. A $200 deposit is worth $28,000. In 7 years. A $400 deposit is $58,000. And a $400 deposit is only costing you $300 or thereabouts. And a $200 deposit only costs you about $150. And a $100 deposit really only costing you $75. And I ask you this question as I close. Do you have a contract in writing or verbally that'll guarantee you that when you reach age 65 to 70, that you'll be in the top 5%? I submit to you, you can be. And it only takes a small deposit along with whatever your school's doing for you. And you can really enhance your retirement. And you've got a wonderful vehicle to do it with. And we have hundreds of products that are really great. Thanks for having me out. Thanks for coming over. Hope you found out something you didn't know.
Appreciate it.
I wish there'd been more of them here. They could have.
You have lots of clients in Oklahoma too, is that
Oh,
what you
yeah.
said?
Yeah.
Is there a way
Are you
to
back
get
quite
a list
often?
of schools that you have
Yes.
clientele with that?
I'm sorry, I had two questions at
I'm
once.
sorry, is there any way that we could get a list of schools that you have clients with, or schools that take care, or you have contracts with schools and stuff, that we might be able to call and talk and
What do you want to call them about?
say?
Do you know Don Patrick? They may not know me anymore.
I don't know you anymore?
It doesn't work that way.
No.
What happens is the school district must approve the products that we have ahead of time. And they have what they call an approved list of vendors,
That's what I mean, is a school district.
you know, and those, they may not even know me or whoever's there. As far as school districts, name one.
When you say you have clients, or?
No, name one. A school district.
Tahlequah Public Schools.
Tahlequah? Yeah, they're old. We have that account, or have accounts there. We don't have everybody at every school district.
Oh, I see.
I couldn't possibly have that many.
Well, the other thing is teachers, public school teachers are not in that much like TIA prep like we are. They're in other.
Most of them are not in TICREF at all. Most of them are in others.
Or Tulsa Teachers Credit Union.
Well, Tulsa Teacher Credit Union is a spendable income account.
Yeah, right.
You know, they're competing with your dollars. Instead of saving money, what they're trying to do is get you to spend it, borrow money and so on.
You were talking about types of accounts. What's the best interest return right now? You're using figures. You're saying if you put in so much a month and that's at a certain rate of interest. what's the best?
Well, the top 10 mutual funds, okay, and there are some differences, and some people wouldn't be comfortable with mutual funds, but the top 10 mutual funds, the range is 14.7 to about 19.2.
There was one out of Colorado in the paper the other day. Last 2 years, they've averaged 27%.
Well, I just had them fax into me, Harold, some here, and yeah, there's,
There was one in Colorado, I just represented the other day.
I need to know the name of it, I can check it, but I submit to you, a 2-year track record is not, in my opinion, not very good. That's scary to me. And it may be a wonderful fund. The top 10 accounts that I'm talking about here in Money Magazine last month was an article on the top 10 funds for the last 20 years. And of those top 10 funds, I handled 7 of them. 3 of them I don't handle. And all 7 of them were within this range. Now, don't get hung up on 2 points here and 2 points there. I mean, frankly, this is not a big deal. I'd be
4%.
well, yeah, I understand, Harold, but what I'm saying, this may have a very high volatility factor. This is maybe very safe, because they rate them as safety factors all the way from a 1 to a 10. And frankly, my feeling is that somewhere in here, you're better off, and maybe splitting it up. If you had $30,000, I might put 10, 10, and 10 in somewhere in the middle range, or maybe you want to put one up here and one down here and somebody in the middle. But again, I wouldn't go with all my eggs in one basket. But you could expect a return of anything above 12. Remember the rule of 72s? Okay, you divide the interest rate that you're earning into 72, and that'll tell you how fast your money will double. 10% interest into 72 gives you 7 2/10 years, and your money doubles. 7% into 72, and in 10 years, your money will double. Most of you have plenty of time for your money to double, triple, and double again. Or it's double, double, double is what it is. The younger you are, the less it takes, the more exciting it gets, really. But guys like him hadn't got much time left. He's got to get this big of money up here.
Time's the key, right?
Right. We're short.
But I'm just looking, here's one.
I just want to ask you for a card. I can reach you.
I'm going to leave some cards here.
That's what I wanted. Business card.
I'll leave this back.
Appreciate it.
Thank you for coming.
Okay, well, we can talk about that later.
I had to take mine tonight. Get Dan to do it.
Over a 10-year period, here's one fund that's had a 362% increase in the value of the fund. If you had $100,000 there, it's worth $362,000 in 10 years. But and there are a lot of them that's got a 5-year record. I've got one here, for example, this year. Here's one 30. There's a 19%. The last 2 years, here's 11, 24, here's 28. Here's another one that has a minus 29 for the last 3 years, and yet they rank, they're their second leading fund over the last 20-year period. And yet the last 2 years they've had a downer.
Yeah. But what's the bad stuff?
Well, a lot of things have happened in the economy. It's not all bad. I'll share with you that you can make money on losses. People that are buying into funds, remember, you're wanting the dollar cost average, Harold. And what you're wanting to do there, if you buy, let's say you had $100 to invest, and the price of shares, when you did it, was $10, how many shares are you going to have? The next time you had 100 to invest and the shares were 20, how much are you going to have? Huh? And the next time you had $100 to invest, the price of shares was this much, $1. You're going to get 100 shares, aren't you? So now you got 115 shares, and it's cost you $300. And now you come and you say, I'm going to quit. It scared me. My shares went down.
But you only paid $3 a share for $3 a share.
Yeah, so you've got a dollar cost average there, and now the shares, let's say, go back to $5. Not to where you paid here. Well, at $5 a share for 300, you got what? 3 5. You got $1,500 there. I'm sorry, you got 115 shares of $5. You got
$65.
$565 or something like that, your cost is $300, you've got a $265 gain. One of my clients, in 1987, when the crash occurred, October, I had a lot of people got antsy about their variable accounts. Sure, they called me on the phone. I said, well, let's talk about it. You go to the university that you went to, you take investment class, and the rule number 1, paragraph number 1 of investing says, you buy when. And when you sell, now the trick is finding when it's both times. And that's part of my job, is to let you know what I think's happened. In '87, the market went off the deep end, but I didn't see any companies going under. That means that all this cross-section of investments these mutual funds were involved in, the value of the stocks were going way down, but the companies weren't going, they still were producing product, they were still making money, they were still trucking right along. So what do? I recommend you buy a lot more if you can, and buy quick. Because now the thing is way down, buy a whole bunch of shares at cheap prices, and exactly that's happened. Now, you said the Colorado funds you're talking about, that's exactly the last 2 years picture you're talking about, 2-3 years. Those funds have gone out of sight. Somebody had to buy them low or they wouldn't have done that. And that during a period of time, a lot of new fund companies got started, and some of them have done really well. But I submit to you that the companies that were already in existence with a 20-year track record prior to the crash of '87 can show you they've gone through periods like that.
And they didn't lose that much.
And they didn't lose that much. In fact, your gain there will be just as good. So, and greed can get into this thing, can be kind of damaging. So, other questions?
On July 1, whatever we've been putting into TID grant, we get to decide.
Yes. Otherwise, they're going to, what the university's going to do is they're going to total up what they have been paying. Teacher return. The remainder of that, you can do with whatever you want to. You can pay taxes on it,
Or I can have it go into
or
some
you can
type
have it go into some sort of retirement account.
Now, they implied in the last bulletin Harold had that you can take that money and your spendable income and go out and spend it on groceries and television and whatever you want. And I submit to you that is not going to happen. You're not going to like what you do if you do that.
So do
fact,
I
I think they're
have to have something set up for it to
Well,
go
that's,
over there?
yeah, by July 1, we've got to be into an account to tell them, take this money and put it into that account, or
Is there
send the money
something I
to
can
you.
take to,
Yeah, she's got some stuff here.
yeah, give me something so he can cipher it out for me.
She got to check that.
Well,
Well,
I think that's okay, but it's a mistake.
what?
Because your accountant doesn't know anything about this tax law. He thinks he does, but he knows very little.
Well,
And-
cipher these things out for me.
I understand.
You get one of these.
But if
And,
it's not, it's not right.
and there are about 4,000 different types of investments you can do. They're all reasonable. In my opinion, more than half of them better than TIACRF.
He turned this on.
This is just one, okay? Don't be hung up on this. This is just one option. It happens to be, I think, a very good one. And I didn't even go into explaining this, see, and so it's a little dangerous for you to see it without me giving you some explanation, but
Well, he can,
no.
well, he can call and ask,
He'd
can't he?
call me,
Okay,
and we'll do our best,
okay.
and then he'll probably come along pretty good. Yeah, you just need some time. I mean, there's an 800 number, you can call me on the phone.
I'm sorry. I'm still
Well, I've got,
It's either my dad or Dr. Ray, one.
boy, I sure don't know.
What does that mean?
That's why I called Don, because I don't know.
Okay.
I really don't. I've already sat down and figured mine, and I know what they're going to pay me,
What about
and then
inheritance?
what I'm going to add to it.
Well, see, no, you cannot put inherited money. A tax sheltered annuity must be payroll deducted. And you can't even put it
So
in
you
by putting it
can't
in.
add any more from what your inheritance or something like that?
There are other things you can do with that type of money, but you can't mix it with your 403B accumulation.
You had a list of
Thank you, I gotta go.
companies that you said were annuities that you sold for and recommended. Is it, it's
That's
in
one
here?
of them. No, that's just one of them.
Oh, this is one.
Harold says, bring to hand out
Okay.
at least what you think is probably one of the best of the bunch.
So this is what you consider
That's one of the best.
bunch.
No, it's one of the best.
One of the best.
Now, I've got the other ones open also. You sent me two different ones. Maybe that's the ones I've got in hand.
Well, I sent you two. One's a rollover concept, and this one is good for rollovers and monthly deposits.
Okay.
The other one I brought you, the other one I sent you is rollovers only. That was different.
And what was that company?
Bankers United Life, it's an Aegon Corporation product.
Okay.
They're all AAA rated, A-plus companies. And you got to understand, and I didn't cover that here, a tax sheltered annuity money, your money is not commingled with the companies. So if they went under, your money's not harmed in any way. It's against the law for them to commingle TSA monies with the company's money. So I still recommend we use AAA companies because it just shows they use good sense in handling their own money.
I see.
But it's not something that's going to have an effect on your
Company
own money.
not rated AAA should still be a safe company to
It could be,
invest in,
sure.
as long as they don't intermingle.
Because they don't commingle your funds.
Okay, okay. So if we were to call you on the
Just dial the 800 number.
number, this is what you'd probably recommend to us, or you
Well,
would
no,
talk
no.
about it further, or?
I would rather have a further discussion.
I see.
Because I would explain particularly maybe that product to you, but I would also explain the others. And maybe your feeling about investments and so on is a little different than this makeup would be. You know, maybe that wouldn't be the thing I'd recommend. Everybody's different. This is the variable problem. Remember I said there's the fixed,
Yeah, right.
and then there's the mutual funds, and then there's the variable that's kind of a hybrid between the two. That's the variable.
Okay.
But that's a particularly exciting one because what this one has done, and you'll see right over here, that's why I don't want to confuse you. Here's a listing. You see, this is Fidelity Investments, Nationwide Investments, Neuberger Berman Investments, Oppenheimer Investments, Strong, 20th Century, Van Eck. Those companies hate each other. They're on each other's hit list. They're competing with your dollar, except in one condition. This company here, the Best of America 4 product, they've cut an agreement with all of those companies to put every one of these products under the umbrella, and you can pick and choose under the umbrella. And furthermore, if you decide you want to move it from Fidelity to 20th Century or back to Nationwide or somewhere else, you can move it without penalty, without taxes, without fees, without any negative consequence at all, and you can do it every day of the week. And you can do it 360 days a year for the rest of your life, and there's no charge for doing it.
See, this is Don's product, and that's what he's going to try to sell you.
Right.
We asked him here just to explain what's going on so we can have some idea. Now, if you want him, if y'all want to get together and say, hey, can you come back in a month or two after we get our letter from the university telling us how much money we've got and stuff like that to show us his product, hey, I think that'd be great.
Then I would probably bring more than one product. I'd bring maybe, where we have some time, you
An
know.
example of a product, and it just, in this case, it happens to be the variable annuity.
Yeah.
Because I said, hey, you know, he wasn't here, he said, I'm not coming to sell your people or anything else.
Give us an
Give you
education
an
on
idea.
annuities.
Yeah.
Well, now in dealing with you at this 1-800 number, this is a California number. That's
Well, it's a nationwide number. I happen to be in California.
right. So as far as your home office, anytime we would phone you, it'd be in your home office in California, and there's not like representatives and we'd
Not
be dealing
deal
with
with
you.
me.
I see.
You've got a rep in Oklahoma City that works for you.
Yeah, and we will in time have more people in Oklahoma.
So you're looking to expand to Oklahoma more with people. I see.
Yeah, but you're not, in an annuity concept, other than the initial interview and then maybe a once-a-year review, it's rare that you need me more often than that. Otherwise, I'm bugging you.
Sure. Well, it's like an IRS or an IRA. An IRA, you just get your statement on a yearly basis from a bank. and-
Well, and anytime, you know, I submit an 800 call to you is no expense to you. I give it to you for the purpose of letting you call it no expense. My clients call me from all over the country, and we can sit and talk as long as you want, and that's not any different than if I were a block away from you talking on the phone. And I can support everything we do then by mail, and then if it requires, then I'll come and sit down with you.
And can IRAs be rolled over
Yes,
into an annuity?
yes.
Okay. So even if they were not
If you got an IRA in a bank
withdrawal-
account, you ought to be making a roll really quick, because they're no good.
They're not making any money right now.
It's unfortunate, but they just aren't. And they're not going to for a while. Yeah, that's what my illustration I was giving you a while ago about those people in the bank were coming up with IRA deposits, just moving it right out of the bank, and then the bank president did, you know. So
Well, I was listening.
the thing is
I was
interesting,
hearing.
a lot of people are convinced that the bank is really a solid situation, but there were 1,397 banks went under last year. There will be over 900 go under this year, according to RTC.
I noticed you had listed savings and loans in your list of put and take.
Should have put X in.
Yeah.
Well, you know, I had a limited amount of time. I couldn't talk about all the products and have any.
Sure.
The main thing to do is get some information across to the few that are interested. Go ahead, and I was glad you taped it. I think that's great.
Yeah, there'll be others that see it. Yeah, there's, you know, when it gets 3:30 in the afternoon, you're going to have a lot of people who are,
And to give you an idea how I work with
Can't
schools
stay.
right there in San Diego, you know, I see it, the faculty, once a year in a faculty meeting. I give them a 10-minute presentation. Then I throw the door open for questions, and then I see them one at a time for an annual review of the clients I've already got that want to talk to me, and the new people that haven't talked to me before. And I go back about every 6 months and do the same thing. And so it's a twice-a-year thing. It's just not a big deal. If we were dealing with car insurance, don't buy from me in California. I can't do you any good for car insurance, homeowners insurance, things where you have claims all the time and stuff like that. But in dealing with money, you know, if you can gain some confidence in me and understand I don't recommend companies that are not AAA rated, or at least A-plus companies, and there's a reason for each recommendation, and I try to tailor-make it for what your criteria is. And then if it's not right, we'll find out soon, and we just simply change it.
well, I got a feeling this video will be watched increasingly as we get towards July.
I think so.
There'll be people seeking out
Well, there's going to be
information.
some
Well,
terrible shots.
where it came up was that I did make sure Don was going to be here. But yesterday, I announced at the faculty meeting this morning, and we had 4 or 5 people like you all that were off for doctor's appointments, things like Mike Brandon's having a thing done on his heart, you know, he's got some problems. He was going to be here today, and so I got thinking, I said, well, why can't we just videotape it, and then they can watch it at their convenience at home? Sure.
Well, I bet typically on the campus, there's just an awful lot of people that are unaware of this.
They don't know. They really don't. They all sit there
But
and
there's
this morning.
an awful lot that would be interested in information on what to do.
And the only reason this came up was because we were all sitting down in Robert's office one day talking.